right, time now to talk winners and losers on Wall Street. We've got Rob Black joining us this morning. Rob, and I'm looking at oil prices climbing past crude oil anyway, up over $103 a barrel. But I don't know, Wall Street paying much attention to that anymore?
Yeah, we're not as centric on driving as an economy as we were 20, 30, 40 years ago. With that said, it's a problem because we manufacture, we put it in planes, we put things in trains, we put things in boats, and that higher energy cost is going to mean inflation down the road. It's sticking longer than we want it to, but it's not really supposed to break. Gas isn't supposed to go under $3 a gallon until next year, 2027. So. Yeah. I'm impressed with Wall Street's earnings that are proven this quarter, and also the expectations for 26 and 27 for the rest. Like, we're good, but that fear of inflation tied towards oil prices it's in the back of my head. I don't like it.
Yeah, it seems weird. It's like Wall Street loves the good news and they rally, but then when the good news seems to maybe not pan out, I don't know. They kind of like shrug that off and just keep focusing on the next thing.
It's all about earnings, and earnings are great in America. Yeah. Like Microsoft said, they're going to let go of some employees. Wall Street's pretty good at managing their labor costs now, and AI is going to really hurt labor in the future. So that's good things for Wall Street.
More about corporate news. Talk to me about Tesla. You've got some concerns about that company this morning.
Yeah, it's you and I have been together for 25 years now in the morning show time area, and we've seen Tesla grow into something quite impressive. Yeah. It was a solar battery powerhouse and an EV, definer, and now they're starting to sputter those divisions. So Tesla's pivoting, and probably wisely so. EV deliveries are down 14% quarter over quarter. They made too many of them in the quarter. They have 50,000 in inventory, so they're going to probably slash some prices and do some promotions next quarter, which doesn't help. So they got bloated inventory. Their battery development and deployment is down 15% year over year, but down 39% quarter over quarter. So they slipped this into the press conference last night, earnings conference call. Yeah. They said robo-taxis we just rolled out in Dallas and Houston, so we doubled our cities. But what they didn't say, it's only one car in each city.
Oh.
That's a little misleading. But the big shift here is, James, and we're going to be talking about it for the next probably 10 years, is they're shifting away from EVs and batteries. They're still going to do them, but they're spending $25 billion on AI infrastructure, on factories, on semiconductors, and on Optimus robots. They're setting the manufacturing out for 27 on the robots, 26 for the semis and the cyber cabs late. But they said we're not going to make a lot of money on the cyber taxis. It's not material for the foreseeable future. A lot of promise. Their cash flow is going to be bad. They're not going to earn a lot of money. No. It's really all about cyber cabs, the semi, and robo-taxis going forward. A little bit of AI as well.
Yeah. All right. Well, I mean, we'll see how that path for Tesla shakes out as it continues down that way. I know Americans, I'm seeing, are spending less because of rising gas prices. I don't know if that means they'll switch over to EVs just yet, but they're pinching pennies. No way around it.
Yeah, the K-shaped economy, the upper part of the K, the affluent, they're doing quite well, the wealthy. But the lower part of the K, nearly 80% of Americans have changed spending because of $4 gasoline. Greater than 50% say gas prices are going to be higher 6 months from now. So they're going to stay high for the long period. And that's going to really eat into the back half of the year. Prices are up 30% on gasoline since the start of the war. So they're at $4 a gallon nationally, about $6 in California. 60% of us have cut back on our entertainment, whether it be concerts, eating out, or movies. And 50% of us plan to travel less. 40% are cutting back on food and healthcare, which are considered essentials. Yeah. And 30% of Americans are starting to rely more on credit cards. So the gasoline is hurting, and it's hurting the middle to lower incomes in America.
But then the other part of that K curve, the one that goes up, the more affluent, they're not feeling it much at all. We've got, some data from, American Express that points to that.
Yeah, American Express is a great small business card, and it's great for affluent travelers. It's, $500, $600 plus a year, but their profit was up 15%. Spend on the cards was up 9%, which is unbelievable. So they're doing fine. The affluent American Express cardholders, they tend to own the stock market and they tend to own real estate. And that's the difference of people who have and don't have at this point in time. People who are wealthy tend to have stocks and real estate.
Interesting. All right. Rob, thank you. As always, we appreciate your insights as these weeks are kind of a roller coaster ride between Monday and Thursday when we have you.
Hey, all-time highs yesterday.
Yeah,
We're
yeah.
good.
This
no
is true.
roller coaster.
This is
We're going
true.
to the moon.
Yeah, 401k should be all right. We're going to talk with Rob again on Monday. So you've got his contact information there at the bottom of the screen. Let him know any questions, any comments, any companies you'd like him to explore, and we'll do that here on Crowd 4. Rob.